Okay, we're going to go ahead and get started here. It's now 12:30. I understand some people are having a tough time getting on. We'll kind of take it slow at the beginning. Hopefully they can figure out their situation as we go along. My name is Marcus Renwick. We're going to talk about the 338 H10 election here. I graduated undergraduate out of Illinois State University. I came down here to study law at Southern Illinois University School of Law. I chose it because it was a very well-ranked school at the time. It had a low cost of living, high bar passage rate, and the graduates seemed to speak high of the institution at the time. I've been a Cubs fan from Chicago since 1987. It's been a tough life until this year. Most of my practice centers around valuing, selling, and deal with tax positions for companies between $3 and $10 million. I got into tax because I took 33 hours of accounting in the undergraduate section, and I also got 2 very high tax grades in law school, and they hired me and I kept it around. What we're going to cover is what is a 338 H10 election, why does this thing exist, the current business situation with many business people, and in order to understand the 338 H10 election, you have to understand the difference between a stock and asset sale, what you do to make this election. There came up a question about the 3.8% net investment income tax or not. Then we're going to cover some frequently asked questions. I hope this presentation is between really 10 and 20 minutes long. I don't want to keep you too long. Okay, the 338 H10 election is covered by section 338 of the Internal Revenue Code. It pertains to the sales of certain businesses. Generally, the seller has to be a C or S corporation, and the buyer has to be a C corporation. And we'll go forward from there. Then why is this important? Why not just do a straight asset sale? It's important tax and legal consideration. It takes the company's legal structure as a whole. This might be important when you're buying a business with a license or a trademark. The company's tax structure is kept whole. That's the distinction between that and an asset sale. The actions of the buyers affect the tax outcome for the sellers. It encourages big companies, C corporations, to buy closely held C or S corporations. Generally, this should be done if the net present value of the taxes in the future are greater than the benefit currently. So in other words, if you're going to get greater returns in the future as opposed to currently what you're going to currently pay out, you can do this election. Otherwise, it's a little bit iffy. Right now, there are a lot of corporations, C and S corporations, that were made during the 60s, 70s, and 80s. Nobody thought they would do very well, but a lot of them, if you look at the situation today, are making millions of dollars, and they have some very good assets for potential buyout. There's also people who started their businesses online, and maybe they've only been in business a year or two. Think of YouTube back in the day. I mean, that was a business where it had been open maybe 2-3 years, and it sold for, I wouldn't say nearly $1 billion. I mean, it just really got up there. Now, granted, that wasn't a 338 H10, but it was an example of a quick success story. Also, a business tends to be more complex than selling a car or a house. Many businesses need to be valued because the owner has no idea of what the business is worth. That's the current situation. Some people think that their business that is only worth $1 million, think it's worth 3, and vice versa. People really don't know what the value of their business is. A lot of business owners tend to do their trade well, but they don't know a whole lot about business. And the buyers tend to be very savvy in this. They tend to have their own attorneys, whereas the sellers, not so much. They're more tradespeople, and they don't understand this. So it's important to understand what a stock sale is and its tax effect. On the stock sale, for the seller, it favors the seller. Generally, the capital gains rate is favorable, 20 to 23.8%, as opposed to selling the assets, which end up being a lot of ordinary income, and that can be taxed at 39.6%. Doing a stock sale tends to shed all the liabilities associated with the company, gets rid of the lawsuits, and you pay off your liabilities, financial liabilities. For the buyer, stock sale disfavors the buyer. The outside basis of the business does not match the inside, and you don't get the tax write-off. So therefore, you get a higher tax result going forward. On the opposite side is the asset sale. That favors the buyer. This is because you get a stepped-up basis in the assets. The assets can then be depreciated or amortized going forward. And then for the seller on the other hand is at a disadvantage. The assets that were depreciated, some are down to 0, make the seller subject to depreciation or capture up to the extent of their original cost. Now, what does that mean? Okay, you buy a computer for, let's say, $300, and you take $200 of depreciation against it. Now, ordinarily, you would think that, okay, if you sell that computer that now has a $100 book basis, and you sell it for $200, you're going to get capital gain on that. No, that's not how it works. If you sell a computer that is now on the books for $100, that was originally on the books for $300, you're going to have a $100 depreciation recapture under Section 1245, which means that is ordinary income tax. Now, if you were to sell the same computer for $500, you would have a $300 recapture, and you would have $100 worth of capital gains. That is a very big detriment to the seller. And if you do that in an asset sale, you still carry potential for tort liability, contractual liability. So here's what a 338H10 does. Generally, it is a stock sale to begin with, and then you convert it to an asset sale. Okay, so let's go through these slides. As we've stated, the effect of the 338H10 is to convert a stock sale into an asset sale. After the election is made, the seller is in the shoes as if he sold his assets, meaning capital and ordinary gain. The buyer now has assets to depreciate and lower his income. The buyer now has the same rights to patents, trademarks, and licenses assigned by governmental authority. So why would a seller ever volunteer to be shanghaied with this result? He's got to pay ordinary income taxes, and the buyer has this advantage. Optimally, the stock sale agreement in these transactions will say to the effect, this part is part of a 338H10 election. Seller agrees to consent to this election for the difference in the taxes incurred on him or her plus maybe a fee, okay? The seller must consent and sign Form 8023 to make this election. Both parties have to make this election and make this consent on Form 8023. Now, this is in contrast to 338G, which is a unilateral decision, but the buyers pick up a tax tab. They then have to file Form 8883, which is the asset allocation. So step one, a regular stock sale of the entire legal entity is sold for consideration to the buyer for $1 million. And we will assume a zero basis to the seller. So therefore you got $1 million minus zero equals a $1 million capital gain in this instance. Assuming a flat rate of 20%, what are the taxes going to be? $200,000. Now the buyer now has a company with an outside basis of $1 million and an inside basis of zero. Now think about that going forward. Is that going to pay a lot of taxes or a little bit? It's going to pay a lot. So step two, the buyer actually has an option to do this or not do this, okay? So the buyer has 12 months to purchase 80% of the company to be a qualified purchase. It is useful when acquiring a large company, such as you look at AbbVie Labs, Trump Enterprises, Dollar General. If those were qualifying corporations, you could probably not buy 80% of those companies in, let's say, a 1 week window. I mean, you would really have to do some hard negotiations. And from when stock number one is bought through 80% stock, it has to be within a 12-month period, okay? Also, after you make the purchase, you have till the 15th day of the 9th month to make the election on Form 8023 and your asset allocation on 8883. The seller signs the consent form. The buyer elects 338H10 status. And the buyer then, on or in the same day, they make the transformation. So you've got Form 8883. You got your asset allocation under Section 338. And generally, you fill in the classes 1 through 7. And it looks like we've got a little bit of time. So let's go over what those class assets are. Class 1 is going to be your cash and general deposit accounts and CDs. Generally, those aren't transferred with the business. Those are taken out of the business for obvious reasons. Class 2 assets are actively traded personal property. It does not include stock of target affiliates, okay? Stock 3 are assets that the taxpayer does marks to market. And generally, those do not include debt instruments issued by persons related at the beginning. Class 4 assets are stock in trade of the taxpayer or other property of a kind that would properly be included in the inventory of the taxpayer. In Class 5 are all other assets, then Class 1, 2, 3, 4, 6, or 7. So kind of a bad definition there. Your Class 6 are very important in a 338H10. They include your 197 intangibles. That includes, just to go down the list here, workforce in place, business books and records, any customer-based intangible, any supplier-based intangible, any license or permit, that's important. Any covenant not to compete, any franchise, trademark, trade name. It does not include any interest in a corporation, partnership, trust, or estate, obvious interest in land, certain computer software, certain separately acquired rights to receive tangible property, interest under indebtedness, professional sports franchises. Did not know that. Class 7, goodwill and going concern. A lot of times, if you look at this transaction here, when you do the 338 H10 election, we're going to allocate $500,000 allocated to goodwill. Goodwill's capital asset, taxable at 20%, so therefore $100,000 in taxes. Goodwill is amortizable over 15 years. Let's say in the same election, we allocate $500,000 to machinery, again, a zero basis, and that results in, let's assume a 35% rate for the seller. So you're looking at $175,000 in taxes. Your new tax bill, $100,000 plus $175,000 equals $275. Now you take the $275 minus the previously paid by the seller, $75,000 due to the seller to make this election, to make it fair. Now, we don't always go above or below that, but generally that's what you get. One caveat for international investors, though, Section 197 does not necessarily apply. In 2001, the International Financial Reporting Standards number 3 was made so goodwill would not be bled out of a business, okay? The Financial Accounting Standards Board apparently, in response to that, also created statement number 142, making a similar rule, albeit different. If you are subject to one of those two rules, you're going to want to explore the consequences of that first. The 3.8% net investment tax, does this apply or not? It took me about an hour and a half to research this. If the business was passively operated to the seller, and you would look back at their tax return, it is subject to the net investment income tax of 3.8%. And when you start throwing around $1 million figures, you're talking big money. But if the business was actively operated, it is not subject to the NIIT. That is a very big distinction there. And two sellers in one business can have different results. You can have one person being active and the other one being passive. That is a possibility. Frequently asked questions, this one's a real important one. Is the 338H10 election a way to save taxes for the seller? No, the seller is in essentially the same position he or she would have been in with a regular asset sale. Okay then, why not just do an asset sale rather than messing around with the 338H10 election? Well, quite simply, in an asset sale, generally the assets break title and the corporate vehicle is put to rest. In a 338H10, the assets keep title and the corporation, which may have all kinds of goodwill and other intangibles, it is kept the way that it is. You're not breaking title. So in other words, if you've got a permit or a license issued from the federal government that says that you can go on this lake at this time, probably shouldn't break that chain. Is there a tax benefit to the seller? Quite possibly. You have to make your own determination on this. Actually, that should be, is there a tax benefit to the buyer? In this case, it had a huge implication. Paying the extra $75,000 more for the $1 million stepped up basis yielded a potential tax savings of $350,000. What companies are eligible for this tax treatment? You've got your S corporations and you've got your C corporations. The buyer generally has to be a C corporation. So in conclusion, asset sales still reign supreme. They are the most common. They're very much bigger than stock sales, and the stocks can be affected by federal regulation and securities rules. We've dealt with this quite a bit. They're very strict in their interpretation, and the 338H10 has its place, and it's becoming more and more common with the business situations going on. And despite it being somewhat complicated in nature, it is workable for any deal ranging from $1 million to potentially $100 million. So I want to thank you for attending. Here is my contact information. If you want to get a hold of me at any time, here it is, and I'd be happy to talk to you in the future. Thank you.